All right, folks, here we are on Trading Nut. We've got Kieran Davis in the house. We've just done an amazing podcast. It is epic, where we talk about things like Teachability Index, Devil's Advocate's way to get out of a trade, and a whole bunch of other things. I think there's like 6 or 7 mindset quotes as well. So check that out. Link below the video. You got to check this out. But now we're going to get to see how he trades and walk through his full-on trading strategy. So Kieran, welcome to the show. Let's get your chart up and see what it's all about. Hey folks, my sponsors City Traders Imperium have just launched some amazing changes to their funded trader program you got to check out. You can now skip the whole evaluation, trade gold as well as Forex, plus they've increased the drawdown you're allowed in both the evaluation and when funded. With C2A, it's even faster and easier to reach up to $4 million in funding with a 50 to 70% profit share. Click the link in the description to find out what else has changed.
Firstly, I want to say thank you so much for having me, Cam. I appreciate you so much and everything you do for the community, man. But let's get right into this. So the biggest thing about our strategy, right, is firstly understanding the industry. And if we just take a look into the industry for a second, how many Forex traders actually fail? We all understand that 70, 80, even 90% of Forex traders end up losing. But the thing is, why are they losing? Why are so many traders struggling? And it all comes down to 2 reasons. Firstly, their mindset, and secondly, their information they've been taught. You know, we have to understand in this industry, there's a big conflict of interest. And first things first, why are so many traders failing? Well, how are most people trading? They're coming to Google, they're looking at these Forex chart patterns. Now, if you trade these, I'm not saying that they don't work, they may work. So the premise of our strategy is we're literally entering where most people's stop losses are. So how do most people trade? Well, most people are trading with these chart patterns, double tops, double bottoms, support and resistance. Now, we have to understand who we're trading against. You see, if we actually start to look at the top 10 currency traders in the market, we've got JP Morgan, Deutsche Bank, Citibank, XTX markets, and so on and so forth. Now, these institutions, they're trading most of the volume and providing most of the liquidity within the market. So because they do that, we need to understand and start to see exactly how they move the market. Let me ask you this. Have you ever entered a trade? Well, I hope so. Have you ever entered a trade? You know, you've got your analysis perfect. It hits your stop loss by 1 pip, 2 pips, 3 pips, and then drops straight to your take profit. You see, if that's ever happened to you, that's because of market manipulation. You see, these big banks, JP Morgan, Deutsche Bank, they have the power to literally move the market because of the capital they're trading with. And again, this is a common fact. If we just go into Google and type in Forex manipulation, we can see so many different articles where banks have been fined from rigging the foreign exchange market. Barclays, RBS, you know, we're talking JP Morgan, Citibank, right? They're getting fined for rigging the market. But let me ask you this. Would you pay, you know, $1 million fine, $100 million fine to make maybe 400 million, 500 million on a trade? I would. I would. So let's start to see exactly how they do this. You see, the premise of our strategy, like we said, we're looking where most traders are getting stopped out, and that's where we're entering. So let's just take a typical, you know, example in the market. Let's say we've got our support and resistance. You know, we've been taught to sell off the resistance, buy off support. Sell, buy, sell, buy. Now, when we're trading like this, our stop losses, we're getting, you know, placed 20 pips above, 30 pips above, right? If we're, you know, entering off candlestick patterns for whatever reason, our stop loss is going, you know, just below the wick if we're buying and just above the wick if we're selling. So what I want you to understand is how this market actually works. You see, the game of Forex, the game of trading, the only way you make money is from taking the money of someone else. It's a two-sum game. In order for you to win, someone else has to lose. So what happens is we have these pools of liquidity being generated. And liquidity is just a fancy word for stop losses and orders, because how do most people trade? Again, they put their stop losses above here, below here, or you've got your breakout traders, right? You've got your break retest traders. People see, oh, you know, if the market's got, you know, if it breaks out, we're going to put a buy stop or some sort of limit order to go ahead and get in the market. Now, because we understand that happens, we can now start to see how the banks trade. You see, because they're trading with so much capital, the way they enter the market, it's going to leave a footprint on the chart. It is very, very obvious where the banks get in the market. So what you need to understand or overstand the fact is exactly how they do it. What they're going to typically go ahead and do is they're going to hedge themselves in the market. You see, they can't just sell the market. They can't just buy the market because you'll see huge wicks. You'll see huge whipsaws within price. So what they're going to do is they're going to hide their orders to the untrained eye. And then you're going to think, oh, the market's random. The market, no, 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 no. The market's not random. It's very intentional. I heard a quote. I don't know the exact accuracy of this, but I heard that apparently every pip the market moves, it costs over $1 billion to move it by 1 pip. So we understand that the market is very, very intentional. So what's going to happen with these institutions? If their agenda is to take market down here, for example, if they want to sell the market and distribute price, what they're going to do is to make sure most people lose. So what they'll do is, where is everyone's stop losses? Up here, right? If they've got money resting up here, they're going to want to take that liquidity by simply entering a massive buy position. So what happens here? Because we have to remember, what happens in the market, most people have to lose. It's the only way people can make money.
Hey, want to trade crypto and gold like the institutions? Well, you can, and it's free for 14 days with Sage Strategies, fully automated trading strategies. Check out their live track records for 25 unique strategies, plus they host everything for you, which is perfect for beginners to advanced traders or investors. Simply sign up for their 14-day free trial today to experience it for yourself.
So what they'll go typically do is enter a massive buy candle, inject a lot of buy-side liquidity. This is now going to think, obviously take out all these traders, right? Everyone who was selling, they've just hit their stop loss, right? Because their stop losses are what? 20 pips, 30 pips above the high. So now everyone who was selling the market here has just been taken out the market. And now what are you thinking? Oh, big bullish engulfing, right? Let's buy. Okay, cool. So now they all go buy the market. So what happens now is, obviously we see that banks have brought the market here, right? Let's say they've brought, 1 million lots, just for example purposes, right? They've brought 1 million lots. What they're going to do now, they've taken all that, all those stop losses here. They're now going to come in and sell the market. Now, why are they going to do that? Well, you tell me, would you rather sell the market here? Or would you rather sell the market here? If you could move it, would you move it to a better price? Yeah, it makes sense. So what they're going to do now is they're going to have two positions open, right? They've got their buy position and they've got their sell position. Now, what we got to understand is the way they actually trade is they don't really take losses. Now, with these trades they're doing, what we got to understand is, because they're not going to take losses, why don't they take losses? Because they have the power to move the market. If you could move the market, would you ever lose? Of course not. So what they do now is they have to bring price back to mitigate. Now, what does that mean? You see, understand that this buy position they've entered here is going to be in drawdown when the market is now sitting down here. And now, because that's in drawdown, that buy position is in a loss, what they're going to do is they're going to bring price back up to close out those initial buy positions. So what we're doing is as what we call smart money traders, that's the umbrella term, is we're not predicting any of this. We're waiting. We're being patient for this to occur. And what we're doing now, once we've seen the facts of the market, now we can go ahead and get in. You see, I'll show you guys some examples on the price chart. But what will happen now is they're going to bring price back up to simply the open or even the 50%. Why the 50%? Because that's just the average. The 50% of that initial buy candle. What that happens now is, once they've brought price back up in this area, well, that buy position now is no longer in drawdown, right? Again, if they entered the market here for a buy and prices went down, they're in a loss. Let's say they entered, 100 million. Comes down, they're negative, let's say 50 million again, just example purposes. Once it comes back up, their trade's now going to be break even. It's now going to be at zero. And what happens now, once price comes back into this area, they're going to close out those buy positions. And now the demand has left the market. There is only supply. There's only sellers living in the market now. And because there's only sellers living in the market, well, the same thing will actually happen here on a smaller time frame, but now price will continue to go lower. And that's where we're looking to enter our positions, to get that nice refined risk reward. So let me actually show you an example now. Let me start to train your eye. So if we just look on, now this works on any asset class, right? You can look on Bitcoin, you can look on Forex, commodity stocks, you can look on absolutely anything. And the easiest one I can show you is actually on silver. Now, if we look on silver, right, what can we actually start to see? If we go on the super high time frame, is the weekly time frame. You see what happens here is, notice what happened. We actually generated a pool of liquidity down here, right? We have this level of support engineered, right? Everyone's coming in. Oh, we've got a double bottom. Let's buy the market. So what does this mean? Everyone's stop losses are simply in the same area. So now remember what's happening. Guys, the market is only doing two things. It's either looking to rebalance or seek and destroy. What's happened is the market needs to come and take out all this liquidity down here. And if we look at now, again, the most retail traders, they're looking at the patterns, the double bottoms, maybe head and shoulders, whatever you want to see it as, and they're placing their stops below. What happens next? Price comes down. If we just replay it, maybe exit it, the replay. Price comes down, it yanks all of that liquidity. It shakes all of those traders out. And now what needs to happen is price has to come back to simply mitigate that. Actually, let me show a better example. Let me show a better example on Bitcoin. This is one that's still playing out. Let me show you a very easy one on Bitcoin really quickly. Yeah, perfect. So let me show a proper example. You see, the way we trade, remember, is most people have to lose. So we're looking at where the loss will occur so that we can actually see where the loss is occurring and then simply piggyback on the bigger players. So let's look at this low here on Bitcoin. Now, with this methodology, it's more of a school of thought than a strategy, if I'm going to be very honest with you. But we understand that most people, right, they're going to place if they're buying the market here for whatever reason. Now, there's always people buying and selling, right? That's the only reason why the market moves. So there's going to be people placing their stop losses here, people justifying why to buy the market here. So what happens now is we've got that pool of liquidity down here. We've got people placing their their stop losses for their buy positions there, or again, their sell stop positions to catch the breakout. So what happens now is we've got this liquidity being generated under this single low. What simply happens now is the institutions, the bigger players, notice how they drive price very specifically below that low. It swoops that low, takes out anyone who was simply buying the market here. They're now in the loss. They're now emotional. They're now thinking, oh, the market's rigged against me. I mean, it kind of is, but they're now getting really upset. What happens now is they may think, oh, we've got a bet. If they're looking at something like this, let's say just replay the chart just by one candle. Oh, we've got bearish momentum. Oh, it's selling. It's going down. It's going down. Let's keep selling the market. Let's keep selling the market. They're selling the market. What happens next? Market comes up and yanks them out. So where are we entering? See, this is where patience pays. What we can identify is the exact point where these banks got in. And we can simply identify it with this, what we call as an institutional candle. It is simply the last sell before you buy candle. And we can see that this candle here, this small black candle, is where the last orders that need to come back and be mitigated. There is an imbalance of price here. Price has to come back down and mitigate because what happened? There was a sell position here that was opened. How do we know? Well, the market literally got sold down. It took the liquidity, it yanked it. And then what happened next? There was a buy position that got entered. Now, again, this is not how we're executing. This is thinking about how the market's actually being moved, understanding the market mechanics.
Hey guys, ever wonder what broker I use? Well, I use these guys, Hanko Trade. Look, it was a no-brainer for me because I was looking for a broker with really good trading conditions and one without any leverage restrictions. Look, also, by joining Hanko Trade, I was able to cut my cost of trading significantly with their super low commission of $1 per 100K. Look, if you want to find out more, check out hankotrade.com or there is a link in the description.
What happens now? And you're going to see the precision of this trading. We're market snipers. We're not machine gunners. We're not running around trying to get every entry. We're waiting for the quality setups. We're sniping the market. And just look at the precision of this. Once price comes into this area, we wick straight in. We don't spend a lot of time. And then we're going to see massive movements from price after that. And now this is a Bitcoin chart. If you want to talk terms of pips, we're seeing a massive, we're talking over a lot of pips the market's being moved. Now, if we also want to look at our stop losses, where would our stop loss be placed? Well, you can simply enter on the open of that candle and you can go ahead and put your stop loss just below the low. And where would we have our targets? Now, again, we're not going to be able to get into targets, but we normally look to target old highs and old points of liquidity, which is up here, right? People would have their stop loss above that small double top pattern up there, right? We can see, if we look on the detail, we've got that double top there. Most traders will put their stop losses above there. So again, there's more stop losses being engineered up there, right? So what will happen? The market's doing what? Seeking and destroying. Price then comes up to seek and destroy. And if you simply have that target, that is a 1 to 8 risk reward. Okay, 1 to 7.95 risk reward. Now, what we can really like to do and what I like to do is I like to refine this. I like to really go down to the lower time frames and take the exact same entry in a lower time frame. I'm going to be honest with you. I'm not going to take a trade like this. Why? Because the stop loss is too big. I don't fancy having a 3,500 pip stop loss. I'll be real, 1 to 8 risk reward is not worth my time. I like to take 1 to 10's absolute minimum. So let me show you. Let me actually show you a 1 to 250 risk reward trade. Now, what does that actually mean for the new traders? That means if you risk 1%, of course, past profits do not guarantee future results. Trading does involve risk. But meaning if you risk 1%, you could have potentially made over 250 times that initial risk. And what we're going to do, we're going to actually go into another video where I'm going to break down a 1 minute execution that had a weekly target. We're talking swing trades with scalp entries.
All right, folks, so there we have it. We're going to see the 1 to 250 reward trade coming up in a second video here with Kieran. Now, before we do that, Kieran, first of all, thanks for showing us this. This is an epic video. Really enjoyed this. Do you want to let the guys know how they can find out more about you?
So you can either go to my Instagram, instagram.com/IKDavis, or you can check out some of these breakdowns on my YouTube channel, which is literally Master of Coin.
Brilliant. Well, look, guys, also, as I mentioned at the start, we did shoot an amazing podcast as well. Link below the video. Go and check that out. There's so much gold in there. You've got to go and check that one out. Also, do remember to hit subscribe, hit like, and click on that little bell, and click all to get notified when videos like this go live, especially Kieran's next video, which is that 250% gain on a trade. So stay tuned, guys. See you in there.